Welcome back to Expat Financial Blueprint, the show that helps you take control of your money and build a brighter financial future.
Absolutely.
Now, in today's deep dive, we're going to be taking a look at the UK's autumn 2024 budget
Yes.
and what it means for you, our UK expat listeners out there, particularly those of you living in Thailand and Vietnam.
Yeah.
Now, I know wading through all the financial jargon and legalese can be confusing, right?
Mm-hmm.
So we're here to try and extract the most important bits and explain exactly how they could impact your personal finances.
Yeah, I think you've hit the nail on the head there.
Okay.
This budget is a bit of a game changer, especially when it comes to things like capital gains tax, inheritance tax, and those overseas transfer charges.
Right.
We'll unpack all of that today.
Sounds a bit daunting.
It is a lot to get through.
So let's start with something that I think a lot of our listeners might be thinking about at the moment with this new budget, and that is selling UK assets.
Good point. Yeah.
What's the big news there?
Well, the big news is that capital gains tax, or CGT, has gone up.
Right.
So if you're a basic rate taxpayer, you'll now pay £8 spawns for every £100 you make on the sale of assets like property.
Okay.
And if you're in a higher tax bracket, well, you're looking at £24 for every £100 gain.
Oof.
Yeah, that's a pretty hefty increase.
I can already hear listeners gasping.
Yeah.
You know, that charming cottage back in the UK might not seem so appealing now, but there's a catch.
Yeah, there is.
This doesn't apply to all UK expats across the board.
You're right. It's crucial to remember that this CGT increase only really affects you if you're selling UK property or land.
Okay.
So if you've got shares or other investments, you're in the clear.
Right.
It also applies if you own a big chunk of a UK business. We're talking 25% or more.
Okay. So that's a bit of a relief for some.
Yeah.
But let's say you are thinking of selling that UK property. Can you give us a real-life example of how much more this could cost someone?
Absolutely. Imagine you've decided to sell your UK home and you make a profit of £200,000.
Right.
Under these new rules, you'd have to pay £48,000 in CGT.
Okay.
That's a significant jump from the £40,000 you would have paid before the budget.
Ouch. That's a big difference. So I guess the key takeaway here is that if you're even toying with the idea of selling UK assets, it might be time to get some advice.
Couldn't agree more.
Don't want to be caught off guard, right?
It's always best to plan ahead.
Absolutely.
Speaking of planning, let's move on to something that could have an even bigger impact on how you pass on your wealth.
Cool.
The budget has introduced some major changes to inheritance tax, or IHT, specifically targeting pensions.
Okay. This is where it gets interesting and potentially a bit worrying.
Yeah.
Can you break down what's changed and why our listeners should care?
Right. So buckle up. From April 2027, any money left in your pension when you pass away will be subject to IHT.
Okay.
This means that anything above the nil rate band, which is currently £325,000, could be taxed at a whopping 40%.
Hold on. So this means that UK pensions, which many expats have traditionally relied on to pass on their wealth, are no longer as straightforward as they used to be.
Exactly. For example, if you have a pension pot of, say, £600,000, your beneficiaries could end up facing a hefty £110,000 tax bill when you're gone.
Wow.
That's a huge chunk of money.
That is a game changer. It seems like this budget is throwing a few curveballs our way.
It is.
So what can our listeners do to prepare for these changes? Is it all doom and gloom?
Not necessarily. There are some potential opportunities here, too, and we'll delve into those in a bit.
Okay.
But first, let's address another hot topic for expats: the changes to the overseas transfer charge.
Right, let's do that.
So the overseas transfer charge, or OTC as it's commonly known, has seen some significant changes that could impact those considering or already using a QROPS.
Right.
That's a qualifying recognized overseas pension scheme.
Right. QROPS, they've been a popular choice for a lot of UK expats, haven't they?
They have.
Can you quickly remind us why that is?
Yeah, essentially a QROPS allows you to transfer your UK pension overseas.
Okay.
It can offer more flexibility, wider investment choices, and potentially lower tax burdens.
Right.
This is especially appealing to expats who've settled in places like Thailand and Vietnam.
Okay, so what's the bad news? How has the OTC changed?
Well, as of October 30th, 2024, a 25% OTC now applies to transfers to QROPS in the EEA,
Right.
the European Economic Area,
Okay.
and Gibraltar.
Right.
So if you're thinking of transferring your pension to a QROPS in those regions, you could be hit with a hefty charge.
Ouch, that doesn't sound it. Could you give us an example of how this will work in practice?
Certainly imagine you're looking to transfer, say, £500,000 to a QROPS.
Okay.
This new rule means you could be looking at an OTC of £125,000.
Oh, wow.
That's a significant chunk of your savings.
That's a tough pill to swallow. But you mentioned earlier that there might be some opportunities amidst all these changes.
Mm-hmm.
What are some of the options expats can consider when it comes to their financial planning?
There are indeed some alternative avenues worth exploring.
Okay.
Two options that often come up are QNUPS and trusts.
Okay.
QNUPS, or qualifying non-UK pension schemes, offer similar benefits to QROPS
Right.
in terms of flexibility and investment choices.
Okay.
However, it's important to note that from April 2027, they'll also be potentially subject to inheritance tax.
So while Q and UPS might provide some advantages in the short term, they don't offer a complete escape from the long arm of the taxman.
No, they don't.
What about trusts? Are they still a viable option?
Trusts can still be a valuable tool for estate planning, even with the new CGT rates.
Okay.
Remember, trusts are now subject to the same CGT rates as individuals,
Okay.
but the key advantage is that if a trust is structured correctly, you might be able to reduce your IHT liability, especially if you meet the 7-year rule for lifetime gifts.
Ah, the 7-year rule, a classic estate planning strategy. But I imagine setting up a trust can be quite complex.
It certainly requires careful consideration and expert advice.
All
Like
right.
QNUPS and trust are not one-size-fits-all solutions. Okay.
They need to be tailored to your specific circumstances and goals.
All right, let's bring this back to our listeners. In Thailand and Vietnam, are there any specific considerations for expats living in these countries?
The good news is that both Thailand and Vietnam have double taxation agreements, or DTAs, with the UK.
Okay.
These agreements are designed to prevent you from being taxed twice on the same income.
Right.
So that's good news.
That sounds like a win for expats.
It is.
Can you give us an example of how a DTA might work in practice?
For instance, if you're receiving a UK pension while living in Thailand, a DTA could help reduce the amount of tax you pay on that income in Thailand.
Okay.
It ensures a more favorable tax treatment for your hard-earned savings.
Okay, that makes sense. But I recall there was a caveat you mentioned earlier about Thailand and Vietnam's stance on foreign income.
That's right. While DTAs provide some relief, it's crucial to remember that both Thailand and Vietnam are becoming increasingly vigilant about reporting foreign income.
Right.
They want to ensure that everyone is paying their fair share of taxes. So what's the key message for our listeners here?
Compliance is paramount.
Right.
If you have UK assets generating income, it's essential to ensure that you're reporting everything correctly, both in the UK and your country of residence.
Transparency and accuracy are key. No one wants any nasty surprises from the tax authorities.
Exactly.
So while this budget has undoubtedly shaken
Yeah.
things up, it's not all doom and gloom.
Absolutely.
Let's shift gears and explore some of the potential opportunities that have emerged from these changes.
Wow.
Okay, what can our listeners do to make the most of this new landscape?
Well, one strategy to consider is strategic timing.
Okay.
We know that CGT rates are set to increase further in 2025 and 2026.
Right.
So if you're thinking of selling any UK assets, doing so before those hikes could save you a considerable amount in tax.
So it's all about being proactive and staying ahead of the curve.
Exactly. Another potential opportunity lies in offshore bonds.
Okay.
These can be a great way to grow your investments without having to pay tax on the gains until you withdraw the money.
That sounds intriguing. Can you explain offshore bonds in a way that even someone who's not a financial whiz can understand?
Think of it like a special savings account where the interest you earn isn't taxed until you decide to take the money out.
Okay.
This can be particularly beneficial in the current environment where tax rates are on the rise.
Okay, that makes sense. So offshore bonds could be a valuable tool in the expat's financial toolkit.
Indeed. And don't forget about your UK state pension.
Right.
The DTAs we discussed earlier can play a crucial role in minimizing your tax liability on those pension benefits, both in the UK and your country of residence.
Right, those UK state pension contributions we made back in the day shouldn't be forgotten, even though we're living abroad now.
Absolutely. Now, I know we've covered a lot of ground today, and it can feel overwhelming.
Yeah.
But it's important to remember that this is just a general overview.
Right. Everyone's situation is unique, and there's no one-size-fits-all solution.
Exactly. That's where personalized advice comes in at Wealth Architects Global. We specialize in guiding expat business leaders like you through these complexities.
We're here to help you make sense of these changes and create a financial plan that's tailored to your individual goals and aspirations.
Think of us as your trusted partners on this financial journey. We're here to help you build a brighter financial future.
So if you're feeling a bit lost in the fog of this new budget, know that you're not alone.
Don't let these changes paralyze you. Instead, use them as a catalyst to review your financial plan and make the necessary adjustments.
Here's a thought-provoking question for you to ponder, given all these changes. What's one step you can take this week to get your financial house in order?
Perhaps it's scheduling a consultation with a financial advisor, researching QNUPS and trusts, or simply reviewing your current investments. The important thing is to start somewhere.
Knowledge is power, and we've armed you with a good dose of it today. But as we always say, personalized advice is paramount.
Okay, so we've covered a lot of ground today, from capital gains tax to inheritance tax, QROPS, QNUPS, even those tricky overseas transfer charges. It's a lot to digest.
It is.
But hopefully you're starting to see the bigger picture. The key message here is that while this budget presents some challenges, it also opens up some exciting opportunities. It's all about understanding the changes and adapting your financial strategy accordingly.
You've mentioned a few of those opportunities already, but let's zoom in on them a bit more for our listeners who are thinking, okay, this is all great information, but what can I actually do? What would be your top recommendations?
Well, one of the most powerful tools in your arsenal is timing.
Okay.
Knowing that CGT rates are scheduled to rise again in the next couple of years, if you're contemplating selling any UK assets, now might be the time to act. You could potentially save yourself a significant sum in taxes by beating those future hikes.
So it's all about being proactive and making those strategic moves before the window closes.
Precisely. And remember those offshore bonds we discussed? They offer a fantastic way to grow your wealth tax efficiently.
Right.
Your investments can flourish within the bond, shielded from immediate tax liabilities until you decide to withdraw the funds.
So it's like a tax-sheltered haven for your investments. That sounds pretty appealing in the current climate.
It certainly can be a valuable tool, especially when tax rates are on the rise.
Right.
And let's not forget about your UK state pension.
Yeah.
Even though you're living abroad, those contributions you made are still working for you. The double taxation agreements we talked about can help ensure that you're not paying more tax than necessary on those pension benefits.
Right. Claiming your rightful benefits while minimizing your tax burden, that's a win-win.
Exactly. It's all about optimizing your financial strategy. And that's where we at Wealth Architects Global come in.
Absolutely. Remember, this is your financial journey, and you're not alone.
You're not.
With the right guidance and proactive planning, you can create a secure and prosperous future for yourself and your loved ones, no matter where in the world you choose to call home.
Thanks for joining us today on Expat Financial Blueprint.
Yes, thanks for listening.
We'll be back soon with more insights and analysis to empower you on your financial journey. Until then, happy planning.